Arista Networks stock is down roughly 17% in the last month after the company reported quarterly earnings results that were solid, but the guidance for the future failed to impress investors and the stock price crashed following that earnings release and statement for future revenue guidance. But does that make it a buying opportunity for 2026? I'll answer that question in this video.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Arista Networks has generated strong revenue growth over the recent decade that has accelerated since the wave of increased spending on data centers optimized for AI. Its revenue since 2020 has soared from 2.3 billion up to 8.4 billion in the most recent trailing 12-month period. However, investors are concerned that Nvidia's networking technology and the bundling that Nvidia can offer to buyers could dampen Arista Networks' revenue growth prospects. And of course, the guidance for the upcoming quarter, the revenue figure being even a little bit less than what the Wall Street analysts were expecting for the company, really just magnified that concern. Investors are hypersensitive to any evidence that suggests Arista Networks' revenue and market share is struggling because of how fearful investors are with the competition coming from Nvidia's networking, which is gaining significant adoption among vendors. Still, Arista Networks has been a very lucrative business. The returns on invested capital have improved from 35% to 51% over the previous decade. A return on invested capital of 51% is super premium performance. It's among the leaders of all of the companies I'm following. And not only are you getting a great return on invested capital with Arista, you're getting a company that's improving. So oftentimes you might get one or the other with the investments. You might get a company that has a great return on invested capital, but the level is flat or declining, raising concerns about the future. Or you might get a company that has improving return on invested capital, but the number is really low or negative. And so it makes you think, well, can they continue this level of improvement when the numbers start getting into the higher levels? And so you have a lot of question marks. You don't have that with Arista Networks. You're getting a company with an excellent return on invested capital and an improving trend. And we get similar data when we look at the company's cash flow to sales ratio. That's improved from 15% in 2016 up to 49% in the most recent trailing 12-month period. Now, this assuages investors when a company is facing competition, especially because you feel confident that if they need to, the company has levers it can pull because it's so profitable. It can offer better terms, it can offer better prices, it can invest more in research and development or advertising or invest more in capability of its sales team to facilitate those transactions. It has things it can do, all right? Versus if you're worried about competition with a company that already has razor thin profitability or even negative profitability or negative cash flow, that's really concerning because there isn't much the company can do at that point to alleviate the loss of market share. So the company is trading at a forward price to earnings of 40, which I think is a cheap valuation for a company that's operating in the category it's operating inside and is generating revenue growth at a compounded annual rate of 25% in the prior decade and even more in the prior 5-year period, with returns on invested capital at 50% and OCF to sales ratio at 50% and both trends in profitability improving meaningfully. These are excellent statistics and metrics for a company, and the only reason why the stock is trading at such a low valuation is because of risks coming from the increased competition, especially from Nvidia, and there will be others. Whenever you're operating a company that's in such a lucrative category, generating such lucrative profit margins, and it doesn't have very strong competitive advantages, you're going to face competition increasing. Even if you have strong competitive advantages, competition is going to try and come in and do something about it and try and gain some market share, trying to carve out an area for themselves. So when I measured the company using the forward price to earnings ratio, it looked undervalued. But when I measured the company using my proprietary discounted cash flow model, it looks overvalued at $129 compared to the intrinsic value of $91. So I'm getting conflicting signals with Arista Networks. On the one hand, great revenue growth, great profitability, great unit economics at an attractive market multiple of a 40 of PE. And then on the other hand, you've got increasing competition from Nvidia, and you've got an intrinsic value per share that's more than 30% below the current market price. So because of those conflicting signals, I have the stock rated as a borderline buy. What I mean by that is it's between a hold and a buy, but closer to a buy in my ranking of this company. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.